new objectives. But before we start, I'd like to remind you that you need to read your textbook. You need to make sure you understand the concepts, the terms from chapter 1, 2, and 3. So basically chapter 4, in order to understand and be comfortable with chapter 4, you need to be comfortable with the previous chapters. If you're not comfortable with the previous chapters, go back and review those chapters. So we're going to start by preparing the financial statements, which is something you should be familiar with. I'm going to cover this very briefly. Then we're going to prepare something called the classified balance sheet, which is a new topic. So this is what we're going to be starting with. Then we're going to follow the learning objectives. So let's go ahead and prepare the financial statements. Okay, this is a trial balance. This is an adjusted trial balance. So this is an adjusted trial balance. You know, the reason you don't see the title, is because it doesn't fit on this page. So this is the trial balance that we've been working with from the beginning of chapter 1, So hopefully you are familiar with all these numbers and you know where they came from, right? Each account, so here's what some rules you need to know, and hopefully you should know by now. Each account, so this is an account, this is an account, this is an account, prepaid is an account, furniture is an account, accumulated depreciation is an account, building is an account. Each account has only one and only one home on the financial statement. Simply put, each account goes only on one financial statement. This is what we are trying to say. No account is ever used twice. And hopefully you should know this by now. If you prepare financial statements, you already learned that, for example, revenues and expenses go on the income statement, dividend goes on the retained earnings, and everything else goes on the balance sheet. Hopefully you know this by now. So the first statement we will prepare is the income statement, and you should all be familiar with how we prepare an income statement. The three headings: revenues are listed first, then expenses, we total expenses, revenue minus expenses. Notice it's a single line. Single line means we are performing a calculation, and double underline, this is the bottom line of this financial statement, 8,550. This is net income. Then we prepare the statement of retained earnings. We are starting with 0 retained earnings on 11/1/2014. Our net income coming from the income statement. Then what goes on retained earnings? Dividends. Dividends going to reduce retained earnings. Because why? Because the owner took money out. So it's going to take money out of the profit. So what's left? The retained earnings. What did we retain? We retained only 3,550. And this number here will eventually appear on the balance sheet. Okay, this is where net income is coming from. And this is the dividend. Notice here they kind of highlighted common stock. Common stock is a balance sheet account. It's not a retained earning account, it's the balance sheet account. Here we have the balance sheet, so everything else goes on the balance sheet, including common stock. Common stock should be highlighted here in yellow. So everything else, cash, accounts receivable, office supplies, prepaid rent, furniture. You know, furniture less accumulated depreciation gives us this number. And what do we call this number? 17,700. Hopefully you remember. It's called the book value. So the book value of the furniture is 17,700. And what do we call the 18,000? The 18,000 is the cost of the furniture. What do we call this building? 60,000 number. This is the cost. What about the 59,750? That's the book value. And this is the total assets. And it should be a review for you. Then we have liabilities, we list them all, total liabilities. Then we list common stock, which is the 48,000, and that's why I said it should be highlighted in yellow to indicate it goes on the balance sheet. And the retained earnings, 3,500 coming from the retained earning statement. So if we add up liabilities and stockholders' equity, they should equal to 113,550. The next thing we're going to look at, instead of a regular balance sheet, this is a regular balance sheet. The next thing we're going to look at is a classified balance sheet. It's going to be the same account. All what we're going to do, we're going to list them, group them, basically classify them, put them in different classes. Similar accounts, we're going to put them together. We're going to classify the balance sheet. We're going to classify the balance sheet. How do we classify the balance sheet? Well, let's see if we know how we classify the balance sheet. So let's see if we know how we classify the balance sheet. Okay, let's take a look at this. first we're going to classify the assets. Let me go to the appropriate page in the textbook. Let's go next. Okay, so the assets, we're going to break the assets into two groups. So we're going to look at the assets, and hopefully you know what assets are. Assets are resources that benefit the company in the future. We're going to take a look at the asset and break them down into two groups. One, we're going to call it current, and one we're going to call it non-current or long-term. Okay, so those are the two groups, current and long-term. Okay, so what are current assets? Well, current assets, they're assets, but why do we call them current? Because they're going to be converted to cash, sold or used up in the next 12 months or within the business operating cycle if the operating cycle is longer than a year. We always assume, for our purposes, is our operating cycle is a year. So current assets is any asset that's going to be converted to cash, sold or used up in the next 12 months or within the company's operating cycle. We assume that the company's operating cycle is 12 months. What is the company's operating cycle? You need to know this term. It's the time span during which cash is paid for goods and services which are then sold to customers from whom the business collects cash. So basically what we're saying is the company takes cash, buy inventory, sells that inventory on account, and collect the cash. And we're going to assume that this is the operating cycle, and we're going to assume that this operating cycle is 12 months. For most companies, the operating cycle is 12 months, but not all companies. Not all companies. For example, Boeing, they build airplanes, they build missiles. Their operating cycle is a little bit longer than a year. Okay, you just have to know that the operating cycle is cash to cash. From the time we invest the cash until we manufacture the product or buy the product, then sell it on account, then collect the cash. This is what the operating cycle is. So any cash and any asset that's going to be used up, converted to cash, or sold within the next 12 months, we're going to list it under current assets. And obviously cash is always cash. So cash is definitely a current asset. So what could be some good examples of current assets? Well, here's some examples. Cash, definitely a current asset. Accounts receivable. Think about it. When you sell on account, you expect to be paid within 30 or 60 days, or 90 days the most, or if you're really generous, 120 days. So no one's going to give you more than a year to pay. So this account is going to be converted to cash within the next 12 months. Current asset. Office supplies. No one buys supplies for longer than a year. Okay, so office supplies are current assets. Most prepaid, no one prepay, usually, generally speaking, unless you are told otherwise, all prepaid are current assets. Because no one's going to prepay for their expenses for longer than a year, generally speaking. Once again, generally speaking. So those are typical current asset accounts. So what we do is we put them all together, we call them current asset, and we total current assets, and our current assets are 16,100. What we did, we are starting to prepare a classified balance sheet. This is not a normal balance sheet, this is a classified. So this is one group. As I told you, the second group is long-term assets. And under long-term assets, you might have three subgroups. You might have long-term investments, you might have plant assets, and you might have intangible assets. But what are long-term assets? Hopefully you know what long-term assets are by default. Long-term assets are assets that will not be converted to cash or used up within the next business operating cycle or 1 year, whichever is longer. So long-term assets are assets that's going to be with us. They're not going to be sold, used up, or consumed within the next 12 months. Well, what type of assets are we looking at here? Well, we're looking at property, plant, and equipment, building, vehicle, truck, a piece of land. Those are long-term assets. And within long-term assets, we're going to break them down into three groups. We're going to have a group called long-term investments. What is long-term investments? It's notes receivable and other investments that are held long-term are considered long-term investments and include investments in bonds or stocks in which the company intends to hold the investments for longer than 1 year. So any investment, so if the company is investing, is bought stocks or bonds, and those stocks and bonds are going to stay with us within they're going to be with us for 1 year or more, we call it long-term investment. Let's look at this company. Let's look at their trial balance. And if I look at their trial balance, let me tell you, they don't have any notes receivable, they don't have any investments. So, but in case they do, we have them in that subgroup under long-term assets. So what's the next section? The next section under long-term assets is plant assets, and we defined plant asset in the previous chapter, and those are the assets that get depreciated. Those are the assets that get depreciated. So they're also called fixed assets or property, plant, and equipment. Okay, so plant assets are also called fixed assets or property, plant, and equipment, such as land. Land is not depreciable, remember, that's the exception. Building, furniture, and equipment. Okay? They are presented in order of liquidity, with assets such as furniture and equipment being presented first and land presented last, because since we assume land is the least liquid. Let's look at this company. Do they have property, plant, and equipment? Yes, they have furniture, and they have accumulated depreciation furniture, they have building, accumulated depreciation building, and they have land. So all these, they're going to be listed under which section? Well, plant asset, but plant asset is considered non-current. So this is the plant asset. This is the plant asset. Let's take a look at the presentation. Notice we have current asset, then everything else is non-current, and we only have plant asset as non-current. Okay? And here's how we present them. Alright, let's go back down to plant assets. Let's go back to the third subgroup. The third subgroup is called intangible assets. And intangible assets are assets with no physical form. Examples of intangible assets include patents, copyright, and trademark. Intangible assets are long-term assets that convey special rights, such as the exclusive right to produce or sell an invention or book, or the presentation of a distinctive brand, which is a trademark. That's what intangible assets are. Assets that lack physical existence, and that's all what you need to know for now. And you need to know that this group is listed separately under long-term assets. And we don't have any intangibles for this company. Therefore, we are done with our asset section of the balance sheet. So the asset section is 113,550. If we go back to the old balance sheet, total asset is 1,13,550. So the total is the same. The presentation is a little different. Let's go back and move on to liabilities. Liabilities are a little simpler because you only have literally two groups. Guess what they are? Current and long-term. So liabilities, we only have two groups. Current liabilities and long-term liabilities. And hopefully we know what liabilities are. Liabilities are obligations that we have to pay in the future because we have an obligation as a result of a past transaction. So how do we classify liabilities? Well, we're going to separate them into current liabilities and long-term liabilities. And hopefully you know the difference. What do you think current liabilities are? Well, any liability that must be paid either with cash or with some other goods or services within 1 year, or the entity's operating cycle, whichever is longer. Okay? So, simply put, if you're going to pay off this debt within the next 12 months, it's a current debt. Some common current debt are accounts payable, notes payable due within 1 year if you have a loan due within 1 year. Salaries payable, the employees want to be paid immediately, like maybe a couple weeks. That's all the time that they might give you. Interest payable, unearned revenue are all current liabilities. So those are all current liabilities. Now notes payable could be long-term depending on when you're going to have to pay that balance back. Long-term liabilities are liabilities that do not need to be paid within 1 year or within the entity's operating cycle, whichever is longer. Many notes payable are long-term, such as mortgage on a building. So some notes payable are long-term, some notes payable are short-term. If we go back to this company, we look at their trial balance. We know that the companies pay their accounts payable within 30 days, their utilities within a month, their salaries within 2 weeks, their interest payable maybe on a monthly or a quarterly, unearned revenue they have to perform the service. Here they have a long-term notes payable. This is for the building. This is most probably long-term. Not most probably, it is long-term. So if we go back to the balance sheet presentation, again, what we're going to do, we're going to create a group called current liabilities, list them all, total them, they total to 2,000. We have a group now called long-term liabilities, and we only have notes payable. Current liabilities plus long-term liabilities equal to total liabilities of 62,000. This is no different than the non-classified balance sheet, the total of 62,000. Now you might be asking, why do we have to do this? Well, you're going to see the value of it later on. There's a lot of value of it, but I'm going to show you the value in one instance. And last but not least, the stockholders' equity. Stockholders' equity is not really classified. We have common stock, retained earning. We total them. They total 51,500. Eventually, we're going to be adding more accounts to this section in future chapters. So this is the classified balance sheet, and you need to know how to prepare a classified balance sheet. So we have the asset section is subdivided into short-term, long-term. Then long-term could also have long subgrouping, and we have liabilities is two groups, long-term and short-term, and equity is usually not subdivided. Equity is just a list of all the equity accounts, which we're going to add more to them later on. Use the worksheet to prepare financial statements. Again, the worksheets are those 6 columns, and if you remember from the previous chapter, I told you we're going to be moving to 10-column worksheet, and under the 10-column worksheet, all the income statement accounts are listed under those 2 columns, income statement, debit and credit. So we have 17,500 credit and 8,950 debit. The difference between those is 8,550. Then on this, under the balance sheet, we list everything except revenues and expenses. So dividend goes here. So we list all the assets, all the liabilities, then the equity, then we add them up. Total debit and total credit, they should not equal to each other, but if we bring net income all the way down to the credit side, if it's a net income, then we add the credit 110,000 plus 110,550 plus 8,550 gives us 119,100, and now they should equal to each other. So basically the balance sheet will help us check our income statement. So notice our net income was, let's scroll back, it was 8,550. Okay, so it's a good check for us, and it shows us all the financial statements on one picture. Notice it's net income 8,550. So it shows us everything on one picture, so it makes our life much easier. Okay, notice the income statement account, then everything else goes to the balance sheet. Explain the purpose of journalizing and post-closing entries. Okay. Now we're going to move into a topic called closing. We're going to be closing certain accounts. We're going to be closing certain accounts. Let's start, see the textbook. Okay, so we're going to look at the closing process. What is the closing process? Basically, a step in the accounting cycle that occurs at the end of the period. The closing process consists of journalizing and posting the closing entries to set the balances of the revenues, expenses, income summary, and dividend accounts to zero for the next period. Simply put, certain accounts are subject to the closing. So we close certain accounts. Close means set them down to zero. So every accounting period, there are certain accounts that we need to set down to zero. So when we start the next period, we need to start with a zero balance. And those accounts are revenues, expenses, and dividends. Those are the 3 accounts: revenue accounts, expense accounts, and dividend accounts. The accounts that we don't close are everything else, which are assets, liabilities, common stock, and retained earnings. Okay, hopefully you noticed this. Anything that goes on the balance sheet, notice this is a balance sheet, do not close. So anything that goes on the balance sheet, such as assets, liabilities, common stock, and retained earnings, those are all balance sheet accounts, and balance sheet accounts we do not close. What do we close? Everything else. What's left? Revenues, expenses goes on the income statement, and dividend goes on the statement of retained earnings. So those are subject to the closing, those are not. And let me tell you why it should make sense. think about your assets. If you have assets, if you have cash, let's assume $5,000. When you start your new accounting period, your cash does not disappear. You don't say, well, this is a new accounting period, my cash should be zero. You don't close your cash. Same thing with supplies, if you have supplies. Same thing if someone owes you money, account receivable. You don't just say, you know what, this is a new accounting period, you don't have to pay me. I need to set my account down to zero. If you have land, if you have equipment, you're going to have those accounts from period to period. Also with liabilities. You would like to reset your liabilities. Well, tell your lenders, I'm not going to pay you because it's a new accounting period, but that's not the case. So it doesn't make any sense. If you forgot, you don't close assets and liabilities. It doesn't make any sense. And for the same reasons, you don't close common stock and retained earnings. Okay? Because it just doesn't make any sense. If you have common stock, if you issue stocks, well, you cannot tell the owner you're no longer the owner of the company because it's a new accounting period, right? Now, for revenues and expenses and dividends, every year the company would like to measure their performance. So every year they would like to start with a zero balance. So every year we have to reset revenue accounts, expense accounts, and dividend accounts. Now we don't delete them basically and they're gone. We don't take them to the trash bin and say, okay, they're gone. We're gonna somehow keep track of them, but indirectly. So we're gonna reset them to zero to run the company, but we're gonna be keeping track of them separately. Okay. So these are the steps in the closing process. And here's step one. So you need to write these down, and we're gonna execute the steps. Close to income summary. So revenues, step one, we deal with revenues. We're gonna close revenues to income summary. This is step one. Step two, we're gonna close expenses to an account called income summary. Then, within income summary, we're gonna have a balance. And if we have more revenues, we're gonna have a credit balance. We're gonna close this balance to retained earnings. So we're gonna debit income summary and credit retained earnings. In step four, we're gonna close dividend to retained earnings. So we're gonna credit dividend and debit retained earnings. And by the way, the accounts that we close, revenues, expenses, and dividends, they're called temporary accounts or nominal accounts. So when we say temporary or nominal, those are revenues, expenses, and income summary, as well as dividend accounts. So what is an income summary? It's an account that we create to perform the closing. And what do we call the accounts that we don't close? We call them permanent. And what are the permanent accounts? Assets, liabilities, common stock, and retained earnings. Okay? So the income summary account summarizes the net income or net loss for the period by collecting the sum of all expenses, a debit, and the sum of all revenues, a credit. So income summary is just basically you park your revenues and your expenses in that account, then you close. Here are the 4 steps. Step 1, if you remember, I said, let me write them down this way you will see them. Okay, I need this worksheet here. We'll come back to it. Okay. Step 1, close revenues to income summary. So the first you need to ask yourself, revenues, do they have a debit balance or a credit balance? Well, revenues will have a credit balance, and you need to know this. By now you should know that revenues is a credit balance, and we're going to close it to income summary. So if we look at this, step 1, okay? If we look at this list, we have service revenue here, 17,500, and we need to make this account go down to 0. So it has a credit balance. So what are we going to do? We are going to debit service revenue. Remember, now we're going to be debiting revenue. I've been telling you for the past 3 chapters, don't credit revenues. However, when you close revenue, you have to debit revenue because you have to bring it down to zero. So we're going to debit revenue and credit income summary. So the first step is to take a look at your revenue account, and hopefully you know that revenue is a credit balance. So you debit revenues and you credit income summary. You debit revenues, so this is step one, debit revenues, credit income summary. The balance for revenues for the next period is zero. Step two is what? Close expenses. And what type of balance do they have? Debit balance. Also to income summary. So this is step two. Let's go back to the trial balance. We have expenses. We have a bunch of them. A list of expenses. Rent, salaries, supplies, utilities, depreciation and interest expense. They all have a debit balance. To close them, we're going to do what? We're going to credit we are going to credit them all and debit income summary. So we're going to credit them all and debit income summary. Okay? And now, in income summary, notice if the total is 8,950. So we're going to debit income summary and credit them all. And what happened when we credit all the expenses? They all go down to zero. They all go down to zero. Let me see if they show it to you in the textbook. Maybe you could see. I want you to see the picture. So notice, it has a debit, you credit, it makes the balance go down to zero. And the same thing for all the other expenses. So now your income summary is 8,550. And this is the same as net income. You remember this number, 8,550? It's the same as net income. Now, step 3. Close income summary. And income summary could be a credit balance or a debit balance, depending on the performance of the company, to retained earnings. So let's take a look at this company. This company, they have income summary as a credit balance because they have more revenues than expenses. Therefore, we're going to debit income summary 8,550 and credit retained earnings. So we're going to remove the net income from income summary and park it to retained earnings. So notice we're not really getting rid of these accounts. All we're doing, if you notice, we transfer all these numbers to retained earnings. The 8,550, that's the result of our revenues and expenses, is now in retained earnings. So it did not really go away, it's in retained earnings. So we debit income summary, credit retained earnings. So it didn't go away. And step 4, close dividend, which is a debit balance, has a debit balance to retained, also to retained earnings. So it doesn't go away, it goes into retained earnings. So because it has a debit balance, we are going to credit dividend to make it go down to zero, and we're going to debit retained earnings, which is going to decrease retained earnings. Now, debit retained earnings, credit dividend. So now what we did is we finished the closing process. We performed all 4 steps. Okay? In this example, if we happen to have a loss, so this example, if you can look at it, if we happen to have a loss instead of income, how the process takes place. So you'll have a debit balance. Notice the debit balance is a net loss. So on the homework, be careful. You don't have to have a credit balance all the time, as well as on the exam. And here's a list of all the journal entries that we prepared. Close revenues to income summary. Close expenses to income summary. Notice revenues, we get a debit, which is unusual. Expenses gets a credit, which is unusual. Then the difference between those income summary accounts is closed out. Since it's a credit, we debit income summary and transfer it to retained earnings. And debit retained earnings and credit dividend to close dividend. And here's the picture of the whole process. a T account picture. So everything goes into income summary, then from income summary it goes to retained earnings. So it doesn't go away, it goes into retained earnings. So notice everything, first revenues goes into income summary and revenue is gone. So revenue, basically what we're saying is revenue is, we finished revenues. Then we say, okay, now we close all the expenses. Then we close all the expenses, we take them to income summary. Now what we do is we close income summary, to retained earnings, and we close dividend to retained earnings. So everything ends up in, you guessed it, retained earnings. Everything ends up into retained earnings. Okay, so if you could see if you could figure the see if you could prepare the closing entries. Okay, and what's the balance of retained earnings? See if you could figure out this problem. Okay. How do we prepare a post-closing trial balance? Every time you hear the word post, it means after the closing. After the closing, you will no longer have the temporary accounts. So after the closing, revenues, expenses, and dividends are going to be gone. Okay? So no temporary accounts will appear on the post-closing trial balance. They exist, but they have a zero balance. So the post-closing trial balance should only include permanent accounts, which are assets, liabilities, common stock, and retained earnings. So here's all the permanent accounts. Notice we stopped at retained earnings. Now revenues still exist, all the expenses still exist, but they have a zero balance because we are starting a new period. Notice this is December 31st. That's it, we did the closing, we're done with the period. So what is the accounting cycle? Basically the accounting cycle is what? What did we learn? Because now we closed the accounting cycle. The accounting cycle is what? The first thing that we did, we started with beginning account balances. Then we analyzed and journalized transactions. That was in chapter 1 and chapter 2. Then we posted journal entries to the ledger. That's chapter 2. Then we prepare an adjusted trial balance. That was chapter 2. Then we prepare worksheet. It's optional. It's a method of doing things. Then we journalize and post adjusting entries. That was chapter 3. Then we prepare adjusted trial balance. That was chapter 3. Then we prepare financial statements, which is starting chapter 4. Then we prepare the closing, which was chapter 4. Then we prepare the post-closing, then the process repeats itself. So this is called the accounting cycle. So by chapter 4, you saw the whole accounting cycle from the beginning and the steps that we take till the end, then the process repeats itself. Those are the steps. Now we're going to use the current ratio to evaluate business performance. Now I told you earlier that I will show you one usage of the classified balance sheet. Why do we do a classified balance sheet? Why do we prepare a classified balance sheet? So this is one of the reasons. There are many reasons why, but this is one of the reasons, and this is an important reason. The balance sheet should tell us the financial health of the company. But sometimes we need to break down the information into smaller components to figure out a little bit more, to read more into the numbers. So one way to do it is to prepare something called the current ratio to evaluate the company's business performance. Okay, so what are the company's business performance? Current ratio is calculated by taking total current assets, and now you know what current assets are, dividing it by total current liabilities, and you should know what current liabilities are. And let's start with a small number. Let's assume you have, current assets, all your current assets, gonna to figure out on a personal level how it works. A current asset of, let's start with $50,000 worth of current assets, and current liabilities of $25,000. Okay, so I'm going to calculate the current ratio. So what is your current ratio? It's total current assets divided by current liabilities, and the answer is the number 2. What does that mean? What does the number 2 mean? It means for every dollar in current liabilities, you have $2 in current assets. Let's assume your current assets is cash in the bank. Let's assume That's the case. That's the only asset you have, and this is credit card debt, which is, you should never have that much credit card debt, or any for that matter, but to make the point. So if you have $50,000 in the bank and $25,000 in credit card debt or different type of debt, your ratio is 2. It means for every dollar in liabilities, you have $2 to cover. So are you in good shape? I would say yes. I would say yes, but the higher this number, the better off you are, or the company is. So the current ratio basically tells us in the next 12 months, this company, they have for every dollar in liabilities. Remember, current liabilities are liabilities they have to pay within the next 12 months. They're in good shape in the next 12 months. So this tells us they are not a risky company, but this is only one measurement of the company's performance. Here we have this company, sample company, and their current ratio is 2. They have twice the amount of current assets than they have in current liabilities. You don't want to have 25,000 in current assets and 25,000 in current liabilities, because the answer will be 1. And surely you don't want to have 20,000 in current assets and 25 in current liabilities. You don't want this number to be less than 1. You want it to be, usually companies shoot for 2. But again, this is a general number. Different companies will use different measurements, but historically 2 is a good number. Nowadays, less than 2 is okay. In some industries, less than 2 is okay. In some industries, 1 for 1 is okay. But again, we're not getting that specific. But generally speaking, the higher, the better, the number. And in Appendix 4A, explain the purpose of and journalize reversing entries. So what are reversing entries? You need to know about reversing entries, that they are optional, they are not required by GAAP, used for convenience and save time. Okay, so I'll just give you a taste of the reversing entries. Record the accrual at the end of the period. So remember, we have accrual accounting. We have to accrue expenses and accrue revenues. Accrual means you have to record the expense before you pay it. You have to record the revenue before you receive the cash. The next day after the period ends, the company can reverse the accrual at the beginning of the next period, then record the cash flow without referring to the earlier accrual. So basically, you prepare the adjustments, then the next day you reverse it, you prepare it just to prepare the financial statements, then you would reverse it to make your books simpler. So remember, we accrued this salaries expense. Salaries expense 1,200, salaries payable 1,200. This is an accrued expense. The next day, January 1st, the company will reverse this entry. Now I'm going to tell you where I used to work. When I used to work, the software had the option. When you are preparing adjustment entries, you would check a box if you want that adjustments, that accrual to be reversed. So what you do is you do a checkbox, and what you do automatically the next day, or when the new accounting period starts, the entry would reverse itself. Why? Because it's going to make the accounting process much simpler. So when you pay the cash, you don't have to remove the payable. You no longer have the payable. You debit salaries expense 2,400 and you credit cash. So you no longer have to worry about this payable that you created. You don't have to worry about this payable that you created. You're just going to say, I have an expense, and I'm going to pay the expense, and that's the end of it. And that's the end of the chapter. Just a few things I just want to make sure I cover with you. Once you're done with the chapter, make sure you try it, all these try it exercises, because you can check yourself to see how well you are doing. What else? Make sure you review those main concepts. This is a summary of the chapter. And make sure you review the summary problem. Here's the problem itself. Then they ask you to prepare an income statement, prepare a statement of retained earnings, prepare a quantified balance sheet, calculate the current ratio, journalize the post-closing entries, prepare a post-closing trial balance. So at this point you could pause the video and see if you can solve these problems. And here's what you should do. This is the income statement. This is the statement of retained earnings. This is the balance sheet. is the current ratio for this company. Those are the closing entries. These are the P accounts. And this is the post-closing trial balance, the last step in the process. And make sure you review the key terms in the chapter, as well as going over the quick check exercises. Once again, make sure you cover the material that you need to cover, work the quizzes, work the homework, and if you have any questions, email me.